What is going on, DeRosa Insiders community? This is Matt Faircloth, and this is the Cash Flow Digest. I want to welcome you guys to the Cash Flow Digest program, and thank you guys, whether you're watching on Spotify, YouTube, LinkedIn, Facebook, wherever you're watching this program. Thank you. I'm grateful for you guys being with us today, and even deeper gratitude for you guys being with us, for you guys watching on our free private community on Facebook called DeRosa Insiders. So guys, if you're watching now and you're not on DeRosa Insiders, just go to Facebook right now, type in DeRosa Insiders and request to join that community. Guess what? We'll say yes. And it's free. It's a free community, right? People are talking real estate shop. Deals are getting discussed on the DeRosa Insiders Facebook community. So make sure you go join that. Guys, one more thing I want to mention before we get going. If you're accredited, okay, and if you're not accredited, it's all good. We have non-accredited stuff that does come down the pipeline every here and again, but we have an accredited only offering called the DeRosa Income Fund. If you're not in the DeRosa Income Fund, you really want to check it out. My man Jacob Sandoval is going to be presenting the DeRosa Income Fund not once, twice next week. One during the regular business day and one in the evening. So if you want to make an evening session, great. You want to make a daytime session, that's even better too. Go to DeRosaGroup.com now and check out more about the DeRosa Income Fund. Quick promo on it, right? DeRosa Income Fund pays out monthly checks. You can compound those checks and roll them back in to increase your principal. We've got people that are well into the double digits on returns after investing with the DeRosa Income Fund just for a year. Third, the DeRosa Income Fund is liquid after a holding period of 1 year. That means you can get your money back. That's awesome, right? So, and the third thing is the DeRosa Income Fund is committed to do what DeRosa is committed to do, which is transform lives through real estate. We've helped open up a beer brewery. We've got a Dunkin' Donuts. We've provided all kinds of housing units. We've got lots of development coming out of the ground in just the 1 year time frame of the DeRosa Income Fund being in its inception. So you guys really want to check out the DeRosa Income Fund and join the great things that are happening. And above all else, yes, we're doing well and we're doing good things with the DeRosa Income Fund. We're also making money. We're producing in the neighborhood of 10% cash on cash return to our investors paid out monthly, right? What are you waiting for, right? Check out DeRosa Income Fund. It's a perfect investment for a self-directed IRA, great investment for cash as well if you want cash flow. So go to DeRosa Group's website to check out more about it, or you can register via the link that Nabiku just popped out there. Thank you, Nabiku, in that. So now today's program is going to be, we're about halfway through, right? The year. With it being just after June 30th. So today's program is dedicated to talking about where we are in the market, what's going on in the apartment building market, and what better person to bring on to talk about what's going on in the market than our market hunter, bow and arrow, our guy, my man, my partner, Hervé Francois. Hervé, come on in here, buddy. How are you today?
Man, it's always a great time to be with you, Matt. I'm doing very, very well. I hope you and the family as well are well also, my man. It's great to be.
Everything's great, man. Enjoying the summer, right?
Yeah.
I want to, but Hervé, we're like, we're halfway into the market. And so I thought it'd be a good opportunity to talk to you about just where the multifamily market is and that. And so we're going to do a deep dive discussion. And so for those of you guys who are lucky enough to be watching live, you guys can watch me and Hervé Terrien and talk all about what we're seeing, how we're making it work, how DeRosa Group just closed one deal and is now working on not one, two deals. That's 3 deals in this quarter that DeRosa Group is processing right now. So guys, we're making it happen. We're dropping thunderbolts. You guys could be doing it too. If you listen to this program, we'll tell you how we're doing it. All right, because we're transparent. Hervé and I are going to go through how we're making this happen and how you can too. So, but before we get into that, Hervé, you've got an interesting article that came out about that. Again, articles are people's opinion put in writing, right?
Yeah.
And that. So let's talk about this article that you found that you and I should break down real quick, and you and I can riff on that a little bit before we get to our deep dive. So take it away.
Yeah, no, I appreciate it, Matt. Thanks very much. The interesting thing about this article, it's actually a nice segue into what we're going to be talking about a little bit later in this podcast in regards to, what we've seen this year, what we're expecting for the rest of 2024, and how we're doing some of these deals, right? And if I would like to put in context, at the beginning of this year, we're talking about like what was the concern? What was the consensus from real estate investors such as ours, right? And this was flowing from pretty much the fourth quarter of 2023. And that was, oh my goodness, there's going to be a lot of distressed deals coming to hit the marketplace. There's going to be a lot of foreclosures. There's going to be fire sales and so on and so forth, because we know so much, floating rate debt was put on deals a couple of years ago. It was time for them to come and refinance. They can't refinance. Interest rate caps are, were not purchased, or they're coming to an expiration and so on and so forth. And so there was a great concern that across the board, there was going to be just a flood, a tsunami of distressed deals hitting the market. Fast forward to today, July 12th, right? We're 7 months into the year, and where is it all? What's going on, right?
There's no blood in the street, Hervé.
No blood in the
Not
street.
a drop.
Not a I'll say, it's probably it's not a deep red color. Maybe it's a pink colorish, but it's certainly not deep red color, right?
Yeah.
So this article, again, highlights potentially why it is this pink colorish and not deep red. And so this article is actually from RealPage, and I got to give credit to RealPage. I mean, it's not just one person's opinion, right? This is a group of analysts, and this is what they do. They study the market, they study the trends, and they do it not only on a national basis but on a local basis as well. And this article, it's also fresh, very new. It just came out just last week. But the title of the article is that U.S. apartment demand surges in the second quarter, and that title just kind of caught my my light bulbs just started going off. I'm like, surges. That's a pretty strong verb. Versus again, what
not big words, man.
Earlier this year, surges is pretty strong. And I was not surprised in regards to the direction of apartment demand going up, because I think I do a pretty good job keeping my finger on the pulse, what's going on across the industry, particularly on a localized basis, or at least regional basis and everything else like that. But again, I was a little bit surprised about the word surges, right? Because that just really leads to, accelerating growth in demand for apartments or whatnot, right? You look at, and it's understandable a little bit, when you take a look at our entire housing industry, it's not only multifamily units. We also, keep an eye on what's going on in the residential market, right? Because there's flows in and out between residential and multifamily back to residential, and so on and so forth. You and I were talking about, how there's some weakness in the residential market, not a lot of inventory, not a lot for sale, right? Interest rates high. People don't want to get locked into higher interest rates. There has been a lot of construction of single family homes and so on and so forth. But what there has been a lot of construction in multifamily units. Knowing this, how can there be a surge in demand for multifamily units, right? And I think those operators or developers, I would say, of multifamily units, they've gotten very, very smart, right? I mean, a lot of them really took it on the chin back in 2008, and they realized that going forward, they don't really want to go ahead and build ahead of not knowing whether or not there is demand for the units that they're going to be building. So they've seen that what had happened over the past few years, that there was a shortage. There was a low amount of inventory for multifamily units. It was at that time they started putting their shovels in the sand and say, let's go ahead and start construction. Now, construction, this is where we get a little bit more localized. It wasn't a strong surge in construction in multifamily units across the country. It was in localized places, specifically those places that saw huge rent growth, let's say in 2022, 2021. We're obviously talking about the Sun Belt regions, the South regions. When we're talking about Dallas, Phoenix, Austin, Tampa, Atlanta, Nashville, and so on and so forth, right? I mean, you're talking about those areas, they were seeing rent growth of 10, 15, 20%. We knew that was an anomaly. We knew that was not the norm, that you did not see that in a historical cycle. And going forward, that would be unsustainable. And it is now unsustainable, right? And so a lot of this construction has taken place, and a lot of this construction has resulted in 250,000 units being absorbed in the first half of this year. That only compares to about 280, 290,000 that was absorbed in the first half of 2021, us coming out of the pandemic, right? So I found that kind of interesting. And the majority of these units, those 250,000 units, they were absorbed in those Sun Belt cities that I just mentioned, because those were the areas where you saw supply was way under supply relative to demand. It's now caught up. And what has that resulted in? It has resulted in tepid to slightly declining rent growth in those markets because so much supply is coming on. But I would not fret because I really believe that it's more of a 2024 phenomenon more than anything else, because those same cities are seeing a lot of job growth.
Is what's happening in Austin an example of this? I know you're going to show us some charts here and whatnot, but I had heard, Hervé, that that Austin is really soft on rents. Not it's not like Austin's going to become a ghost town anytime soon or nothing like that. So I'm not saying y'all need to start fretting or whatever.
No.
Austin's got tons of good job growth, tons of employment options and everything like that. It's just, you can't pour but so much new units into a market and not have an absorption issue and have a supply demand curve shift. Is that an example of what you're talking about?
The perfect example, Matt. It's a perfect example. Austin itself is seeing rent decline of about 7.5% to 8% this year alone.
Wow.
And that's due to so much of the supply coming on. Of the about 470,000 units hitting the markets this year, I think it's even north of that. You've got about 40% going into Dallas, Texas alone, right? And about 19% hitting Austin. But again, because Austin's market is not big as Dallas's, it's not big as, let's say, New York City, which is also seeing 19% of that 470,000 come in. But New York City, as we all know, they have a much, much bigger housing stock. So that increase in supply is not going to negatively impact them as much as it impacts Austin.
Yeah. Go ahead and show your chart. Yeah, I've heard so much and people talking about those markets that are the darlings of the world, like Austin and Phoenix and Atlanta or whatever. And that's just where all the cool kids are. That's where a lot of folks are building and whatnot. So if you've got that much inventory coming on, of course you're going to have you're going to have some rent suppression or rent issues with the market having to absorb all that stuff that got built over the last 2-3 years.
That's right. That's right.
So take us through what you got here.
Yeah. So, overall, when you take a look at the rent change on a regional basis, when you sum it all up, we're looking at rent growth was only up 0.2% in the month of June. When you break it down, you see exactly what regions had strengths in rent growth and what regions did not. We just finished talking about the South. Rent growth on average declining 1.5%, but exacerbated by, let's say, in Austin. 7.5%.
I'm smiling because I'm looking at where your 2% are.
That's right. 2% right in our backyard, right?
I know. It's not that, and then that's honestly not where we invest. You and I live in the Northeast.
That's right.
You think about a couple of years ago, people would be like, the Northeast, like that's going to be a ghost town. Nobody's ever going to invest there. Nobody wants to live there unless they do want to live there. Unless not everybody's going to move out of the Northeast and move to the Panhandle of Florida or move to Orlando or whatever. Maybe people did. I'm sure they did. But the Midwest is too, like the part of America that's forgotten, that not enough people are talking about. The breadbasket of America, the center of our country, is a part that's been forgotten for so many years. People talking about the Southeast, the Southwest, moving away from the Northeast to those places. But you forget about the Iowas, the not to self-promote here, but the Minnesotas of the world and whatnot, right? These are markets that are growing still, and there actually are people that do and want to live in those places. They actually are beautiful, although they're not, right next to Mickey Mouse's house. Right. They actually are good places to live. Right?
Yeah. Listen, case in point, as you know, right, we were visiting my son in Madison, Wisconsin, last weekend for July 4th weekend. That's where he's living right now and whatnot. And we took a day to go over to Milwaukee. And, you'll see another chart up here that we'll put up. But Milwaukee is an example of one of those Midwestern cities. Madison as well, that has been experiencing some strong rent growth this year, right? Our executive producer, Nubiku, thanks very much, blowing this up for us. And whatnot. And you'll see that Milwaukee right there, with its rent growth. What was surprising, we didn't touch upon it in the last graph, and you don't have to put it
Newark, New Jersey. Yes, he said it. It's there.
It's there.
Chicago, Chi-Town.
That's it.
Dare I say? Hervé, I'm sorry. That is not Dallas. That is not Orlando.
Oh, it's not.
Right?
It's not Phoenix.
Okay.
No. Yeah. Exactly. Right. And there's your rent growth, right? And now, you're seeing some of these cities where you have nice rent. But hey, shout out to investors, hint to investors, not only nice rent growth in those cities, but cost of living very attractive in those cities. Again, if you wind up wanting to still go into, let's say, the Dallas and the Atlantas of the world, or Jackson, you're going to be talking about cost of living in those areas. They've picked up. They used to be cheaper, there's no doubt, but there has been so much migration that cost of living in those areas are going to pick up. You will see rent growth come back in those Sunbelt cities, I would say beginning in mid 2025, particularly once that absorption really starts to get soaked up and things like that, relative to all the supply that has hit those markets this year. Because like you were saying earlier, there's a lot of job growth in those cities. Atlanta, not going anywhere. Austin, Tesla in Austin, not going anywhere. Nope. And Dallas and Phoenix and so on. So Phoenix is almost our semiconductor capital of the United States nowadays. Intel and Samsung putting in big semiconductor facilities right there in Phoenix. So, or right outside in Scottsdale and things like that. But what these cities have, particularly these Midwesterns, Milwaukee, Cincinnati, and Columbus and so on, so Kansas City, relative to those other, is nice cost of living. So I see our youngins moving out there to the Midwest, a little bit of both, right?
Yeah. It's interesting. It's interesting that, like you think things last forever, right? And you think that the whole world, it's like every cool kid I know moved to Austin, right?
Yeah.
But it's only a matter of time before a city, this is just an example, just because it is, like Virginia Beach, right? Mm-hmm. Let's say a major company, let's make one up right now, Dropbox or Google or whatever, decides they're going to put a new HQ there in Virginia Beach because it's near the ocean. It's there's other job bases there. There's good education centers that would give us a good job base. It's okay. Yeah, we're gonna make Virginia Beach it, right? Yeah. It's not like Austin's been the hottest thing since sliced bread for the last 30 years, right? Austin has not. Austin was a small little city until tech decided to move their way in, and the city, rightfully so, made it easy for businesses to do business there. One of those, or two or three of those 10 cities, such as Greensboro, as we know, has made it easy for companies to come in. Absolutely. The next Austin is on that list, and it's not going to suck all the attention away from Austin, but the next city that we as real estate investors should be looking at, maybe right in front of you, right there.
Absolutely. Columbus, Ohio, perfect example of what you're talking about, Matt, right? Where
Columbus is building chips. There's chips going into Columbus right now. And I'm not talking about Lay's potato chips. I'm talking about microchips.
Right? Right? That goes into our cell phones and cars and things like that. So absolutely, man.
We're not going to be buying that stuff from China for much longer, man. We're building a lot more chips in the U.S. now.
Bringing it back home. So I thought this really would provide some interesting insight as to the transitions, right, that are taking place in supply and demand in the marketplace in the first half of this year, whatnot, and not to get stuck. So, what you could be a consumer that benefits from this information and this graph. You can certainly be a producer, a real estate investor, an operator that benefits from the article and the information in this article, as well as these graphs, right? And if you are just getting started, and Matt, that we have our cadre of students, right? And a lot of times they come to us and they say, Hervé, where should we invest? Where should I invest? And it's such a big country, so on and so forth, right? These are the kind of things that I look at to help them narrow down where they could invest, right? It's not always going to be, outside of your backyard or whatnot, right? Granted, Newark is seeing some strong rent growth, but you're also not only strong rent growth in Newark, but some of the highest rents in the country out of Newark, New Jersey. You're talking about a one bedroom on average, $4,000 a month, right? I mean, that's insane, right? So, here comes sheetrock to split that room in two, right? Because that's the only way you're going to be able to afford that. So, but other cities in that area can be really, really, really attractive investment opportunities.
Yeah. So, guys, Hervé is way too humble to promote himself here, but he developed something called the Market Hunter tool that's there on the DeRosa Group website. Our ghost in the machine, Nabiko, could gladly post the link to the Market Hunter tool, or there it is right there, DeRosaGroup.com/market tool, 2 T's, market tool. Go grab that. Hervé developed that tool himself. And what that tool does, guys, is it does exactly what Hervé just did. It goes and helps you collect the data on markets, and it will score markets alongside you. You just fill it in, and it'll tell you whether your market scores out as a good market, a mid-tier market, or not a good market to invest in based on data, not based on your opinion, not based on what you read on Facebook, not based on what me and Hervé has to say, and certainly not what some cool kids doing that you hear talking about a podcast that they're building a bunch of apartment buildings in Austin. These are real items of data that you can use to pick a market. Now, you're going to have to put it in. It's not going to spit out and say, you should invest in Columbus. You put in the data, you go get it. You do have to work for it. That's okay. But go to right there, and it's going to enable you to find the markets that's going to work the best for you. So go to derosagroup.com/market tool to grab that. Guys, this is just a brief comment on the Real Page article that Hervé found. Great find, Hervé. If you guys want to hear me and Hervé talk about what DeRosa is doing to go and we, like I said, we got 3 deals one that we just closed, 2 we're doing right now. 3 in this market where a lot of people are in the waiting place, sitting on their hands, waiting on the market to change. We're not. We're making it happen, right? So if you guys want to hear how DeRosa Group's doing it and how we recommend that you go forward and get and take action and what we see coming in the next market, make sure you watch live, which we're going to transition to now and do this live, or just jump over to our YouTube channel or our DeRosa Insiders page on Facebook and join that so you can hear our conversation. And next time we're going live, you guys can type in questions to us live like you can do right now. So thanks for watching this YouTube video. Appreciate you guys. All right, everybody, let's hop in, man. Let's talk about, like, now, give me Real Page aside. I'm not saying that article doesn't matter. It's a really great article, but give me the Hervé Francois opinion of the market and where you see things going. Tell me what you've seen outside of that article, with regards to deals coming across our plate, where you've seen pricing at and everything like that. Give me your, looking back history lesson over the last 6 months.
Yeah, I would say it's a great question, Matt. I would say what I have seen in my day-to-day and a lot of the conversations that I have with brokers, over phone, email, and so on and so forth, a lot of the listings that we have been getting from brokers have been really, really big deals, right? There have been some smaller ones, but when I mean really big deals, folks, I'm talking, 400 unit for sale, 5, 7, 832 units for sale, right? These are the size properties.
1,500 the other day.
Yeah.
A syndicator you and I both know did a little Facebook post like, hey, I'm looking to sell some things. 1,500 doors. I'm like, oh,
God bless, man.
Wonder where that's going. We wonder why you're moving that right now. Huh.
Yeah, that's the thing, right? And I think that's, a lot of institutional buyers type of deals, you're seeing out there. I was reading an article the other day. It was kind of interesting. It makes sense, Matt, remember we were at the Best Ever conference back in April. I was on stage, John Chang, Mark Smolcap, and we had a lot of fun.
That's
there,
great,
right?
YouTube politely duked it out. It was great. Yeah, we
had a great time. But earlier that morning, a lot of the big banks, the heads of the real estate divisions of those big banks, Goldman Sachs, Morgan Stanley, Brockart, they said, "Hey, listen, we are getting bullish on." This was back in April. Early, we're getting bullish on multifamily. We are going to go ahead and put 2 feet in. We're going to start digging in. We are in acquisition mode in acquiring multifamily, right? They can make that decision perhaps quicker than individuals and smaller operators like ourselves because their risk tolerance is very different. Their pockets are much deeper and so on and so forth. And they got to really put money to work, right? Or else they risk getting, redemption requests from their investors. And so that's why they've started doing. They have started snatching up these huge deals. And I think that's why we keep on seeing the listings of these deals, because there are buyers of those deals. When the head of BlackRock, when the head of real estate at Goldman Sachs says we're getting more bullish on multifamily, well, then if you're an owner of one of those 1,500, or 800 unit apartment complexes someplace around the country, especially in the Sun Belt, you're going to have some interested buyers because they've made it public that they want to go out and buy and things like that. So that's one of the things that I kind of interesting that I saw. I think operators such as ourselves, non-institutional, there's obviously a lot of interest from us to go out and be very acquisitive right now. A lot of interest. We're halfway through the year. I think it's safe to say we have underwritten probably over 80 to 90 deals so far this year.
Mm-hmm.
And it could be higher than that, but 80 to 90 deals, ones that were real. And as you know, Matt, we've submitted LOIs on some of those as well, right? Only unfortunately get beaten out for one reason or another, a lot of it on price. I think the reason why we just haven't been able to submit more LOIs, and this is, pretty much stating the obvious, is the loan terms, right? Just not been very attractive for us. We had that discussion all the time when I say, hey, man, I think we have a fish on the hook. We take a look at the cash on cash for that particular deal. I'm like, this is going to be a challenge.
Right. Yeah.
Right?
Because of today's debt terms, Hervé, you and I are looking at stuff that's priced under today's pricing, under today's cap rates, which have still gone up. Not 4.5, 5 cap stuff anymore. 6.5 cap stuff is what we're seeing. Even under today's debt terms, those deals still don't cash flow at all in the first couple of years. We're looking at like 1%, 2%, 3% cash on cash. And I'm over here like, Hervé, our investors, and as you and I both know, right? You and I are both finance guys, right? Like you look at that and you're like, an investor could just put their money into a CD and make 4 right now. How am I going to go and try and convince one of our hardworking investors to put in money and make 2, 2.5, 3% and crush the fingers and magic fairy dust and hope that good things happen and that the deal produces 7 or 8, 2, 3, 4 years down the road? We've seen other operators put deals out there that are under those scenarios. It's tough to raise. It's tough to raise right now because of today's debt terms.
That's it. Exactly. Now, so and you're 100% right, man. And so what happens is all of us, right, are keeping an eye on what the Fed's going to say, what the Fed's going to do, and the language that comes out anytime that they talk.
It's like the Wizard of Oz, man. I mean, everybody crowds around real close. Let's see what
he's going to say. What do you think he's going to do? Right?
Yeah. What's the wizard going to do?
Yeah. I have to get rid of the term crystal ball and replace it with clouded ball, because all of our crystal balls are clouded right now, right?
Nobody knows, man.
It's just
supposed to raise rates 3-4 times or lower rates 3-4 times this year.
Right, we haven't done this, right? And so
there's a 50-50 shot he does it at all,
Right. Expectations is that it happens in September. So now we have to play.
Yeah, but the expectations were he was doing it in April, and the expectations we could do it in February, and the expectations we could do it in June, right? Because I remember having these conversations with you, right? And I'm done expecting anything aside from status quo, man. I mean, honestly, you and I have talked about this really, and this is like a year marker for students. For right now, guys, I would say that you just assume rates are going to be where they're at for the foreseeable future. This whole survive till 2025 thing was hoping that rates would go down by 2025. Guess what? Maybe not.
They
Maybe
might not.
Yeah, maybe you got to deal with 6% for a while.
Listen, rather than trying to forecast when rates are going to decline, I think the better discussion, Matt, is what happens to this market once rates do decline. You pick the month that they will decline. You pick the year that they will decline. Yeah. But when they do, what should we expect to happen? And how should position yourself when rates start going into a declining phase?
Well, that's just a transition. That's something like we're doing a deal right now, and we're not buying on agency debt, right? And that's because agency debt, they kind of lock you in to the rate that they got, which would on that deal would have been like 6.2, 6.3%, right? Yeah. We're getting around the same rate, if not a smidge lower, from an insurance company. Yes, low LTV. Yes, that's what insurance companies are going to ask you for. But in exchange for that low LTV, which is going to require you to put more equity in, yes, you got to break rocks in the hot sun, as Hervé says, a bit harder and go out there and get that equity. But your rate's going to be a smidge less with insurance companies. And when rates do go down, when they do, right? Could be 3 years from now. Who knows? Forget about survive till 2025. How about 2028? Fine. Hang on till then, right? If your deal cash flows enough today to keep your investors happy, model it with a refi under a more reasonable interest rate at some point when it does. And the insurance company we're doing a deal with has a prepayment penalty that's palatable. It's not, yield maintenance or defeasement or any of that kind of jazz where you're going to end up paying millions of dollars in interest. So Hervé, that's one strategy that we're doing is just swallow that jagged little pill of accepting what rates are today and being what that is what it is. Forget about getting a floating rate debt and hoping and crossing your fingers and hope that rates go down in a year.
Right.
Maybe just accept rates today, but structure your deal to the point where you're nimble enough you can refi when they do go down.
Absolutely. And then, listen, there's a lot of different type of financing arms, right? You just talked about this life insurance company that we're using. Still the credit unions, is private capital, and so on and so forth, right? So there's a lot of different and folks, these folks, they want to loan. They want the agency and the bridge guys, they want to loan as well. They don't want to be sitting on their capital, right? When they have to get budgeted for 2025, they want to be able to go to Congress and say, hey, listen, we need this much money because we got all this demand for loans and everything else like that based on what happened in 2024. And they want to be able to loan out more in 2025 than they did in 2024 and things like that. So folks, they want to, but listen, it's going to take a little bit more homework on your side to really find out the best loan terms and the best loan vehicle that you should use for your deal. No doubt about it.
Yeah. The other idea that Hervé and I have with regards to debt, before we move on and about other strategies or whatever, the other idea that we haven't done this one yet, and this takes someone who can raise a reasonable amount of capital, right? So if you've got the ability to raise, let's say 3, 4, or 5 million, right? Not everybody does, but let's say you do, or you can assemble a collective that can raise that kind of money, right? Mm-hmm. The idea that Hervé and I have tossed around is banks want 6 to 7% on their money. Investors also want 5, 6, 7% on their money, but investors also get other benefits that the banks don't. Cost segregation studies, cash on cash return on ups. They get a piece of upside if you want to pay them that, if you want to structure your deal that way. So the idea that we had is why do you need a bank anymore, right? Why wouldn't you just go and buy a $2, $3, $4, $5 million asset and just finance the whole thing with investor equity and maybe a couple of different share classes? And then when rates do go down, whenever they do, 3 years, 2 years, 1 year, 6 months, whatever, refinance that asset, return a bunch of your investor capital. Investors are going to be happy because they got a lot of their money back, right? And they still got some equity in the deal, right? It's a win-win across the board for you and for them. And you can certainly structure a really interesting arrangement with your investors, because this is one of the few points in time where investor expectations matches bank expectations, and bank expectations is always, since I've been in the business, has been less than like banks have wanted this while investors wanted this. They're somewhat equal, in a lot of ways now. Now investors are going to want long-term upside, and you could deliver that when you do refi, right? Absolutely. So that's another idea that you guys could try on in today's market. Takes the right deal, takes the right value add opportunity, and also takes the right operator that can raise the significant amount of capital to make it happen.
Yep. Absolutely. Yeah.
What else you say? All right. Now, Hervé, I know your crystal ball, now your foggy ball, break out your and tell me where you think the rest of 2024 is going to look like with regards to deals, deal flow. I forget what the Fed's going to do for the rate. It doesn't matter.
Yeah.
What are you seeing deal flow wise?
Deal flow wise, listen, I don't believe that we are going to see a lot of distressed deals coming through, right? Which was what the expectations were late last year, early this year. And I know people are still waiting. So I think if you're waiting on the sidelines, I'm going to wait until these things wind up trading 40 cents on the dollar before I step in, you're going to miss it. You're going to miss everything. And then, God forbid, or God willing, that there is a rate cut between then and then, you're really, really going to wind up missing it. So I would not be sitting there waiting on the sidelines for fire sales to come through. You're really, really going to wind up missing it. Number one.
Because a lot of people are just waiting. You look on Facebook, man, everybody's just waiting.
They're just waiting
for the market to change, waiting on things that, and they don't realize that when good deals do happen, when there's blood in the streets, you're not going to see it.
That's it.
Yeah. And that's what I've been telling people 3 ways from Tuesday. Unless you zoom in on a market and become a market expert on one market.
Very good.
Just one market. Right? That's how you're going to see the blood in the streets. But if you try and sit around and wait for a LoopNet to give you deals that are trading at 12% cap rates, forget it. Because everybody else is doing that too. There is an unprecedented amount of equity, dry powder, so to speak, on the sidelines right now, and you're going to be last in line if you're waiting on the market to crash or waiting on great deals to just show up everywhere. Not going to happen.
Absolutely.
What should we do? What should people be doing, Hervé?
We should be actively looking at deals. We should be actively looking at deals. You should be actively having conversation with brokers. You should be trying to meet up with these brokers. These brokers, we all know how they feed their families, right? They're trying to get paid too, right? I mean, I've got some broker calls I need to take that I need to do this afternoon. So you should be actively having conversation with brokers. They are not actively having conversations with a lot of people like they were a couple of years ago. It's a great opportunity to go ahead and expand your reach, expand your touch into brokers. Get on their emails, get those listings, underwrite those deals. Even if the deals don't work out for you, get the feedback to the brokers so he can continue to go ahead. She continue to go ahead and feed your pipeline of deals. Go and check these out. One of these tips that I gave to a student is if you see a property in a market that you've identified as a market that you would like to acquire in, then and this property is currently not listed for sale, take down the address, give it to the broker, and let the broker go on a fishing expedition, him or herself. This is something that we've done in the past. And don't do it with one property, do it with 10 properties. Keep them busy. And you let the broker know, hey, listen, if you're able to go ahead and get that seller to list that property with you and the numbers work, I'm buying it from you, okay? You're going to have that broker get up off his or her chair, which is they've been sitting in front of the computer, doggone, 6 hours a day and probably out just for 2 hours a day, going around and talking to sellers. And then they're going to be out there actively hunting for you, right? And if you have to get into an exclusive with them, fine. It doesn't hurt because you have brought them deals that you would be interested in buying again if the numbers work out, right? So that's something that I would certainly be doing. Like I said, continue underwriting deals and continue to submit offers. You have nothing to lose. Look, as you know, Matt, we were talking to one of our students a couple of nights ago, and she underwrote a deal that I went ahead and I put it into our chat group with the students. And, when she saw what their asking price was relative to the offer price, she was able to come up. I think she was like $200,000 to $300,000 away. She's like, oh, well, I'm not sure if I should submit an offer. Are you
ready over?
Submit the offer. Submit the offer. You got to submit the offer. Submit it a little bit lower. Submit a little bit lower. Give yourself a little bit of wiggle room.
Yeah.
And, but like you said to her, right? You want to spark that conversation and keep that conversation going and going and going. Oh, yeah, I don't want it at 7.2. You want it at 8? Okay. Back and forth kind of. So you want to keep that going because there are no offers. One deal, as you know, that we're under contract right now in North Carolina, Matt. We submitted below asking price and we wind up getting the deal, right? I mean, that's, significantly.
Deals aren't trading for asking anymore. That's the whole thing. And a lot of brokers don't want to accept that fact, but whisper price is no longer a guide. It's price guidance is no longer price guidance.
Right.
So what I would say to like underscore that whole thing, guys, turn in offers. Get out there, make offers on deals. Even if the offer doesn't embarrass you just a little bit, your offer's too high. That's right. Make an offer on a deal that works for you, or there might even be a home run price for you in that, and try and engage in a conversation, because I've found more and more deals trading for way less than asking for sellers that are really, really looking to move. And that leads me to, I believe we're going to see not blood in the streets unless, if you're the way you're going to catch blood in the street, guys, it's going to be there. There's going to be bank foreclosures. There's going to be deals that people are just like, they're absolutely trying to unload and stuff like that because they're in a pinch or whatever. It's not going to be on LoopNet. You're not going to get it in your email inbox. The only way you hear about that deal is if you are plugged in, as Hervé said. That broker knows you. They know you can close. They know you're funded. They know what you're talking about. And if you're brand new to the game, then talk a good game that the broker should be giving you a shot for something that they get that's like, hey, listen, this is a screaming hot deal. It's got to close in 30 to 45 days because this person's in distress and needs to get out. You might get those deals, right? But only if you're plugged into the market. Certainly not if you're shopping, 3, 4, 10 markets across the U.S. And certainly not if you're sitting on your couch surfing LoopNet.
Right. Absolutely. No, 100% right. So listen, I know, for us internally, Matt, that's what we're going to continue to be doing. We always look at a market here, market there. I like for us to be very focused in where we currently have a lot of our assets and whatnot. We certainly will look around. We'll look at markets around where we currently have assets, even more so because we have DeRosa Living, as our internal PM. And so there's a lot that we can leverage with having our own internal property management company. But it's, myself and our underwriter, Hayes, man, we are just going to constantly be looking at deals, analyzing deals, underwriting deals, and whatnot. So you have to stay active regardless of, where interest rates are going, whatever Fed Powell is going to be saying any given day, and so on and so forth, right? You just got to keep on submitting those offers, right, and underwriting the deals. And this is a great time, like I said, develop a relationship with those brokers and get a great understanding of what's going on in your market. A lot of these markets are changing, man.
Yeah, man.
These markets are changing. No one would have thought Newark would be acting the way that it is, and cities in Florida acting the way that they are right now, cities in Texas. And then we talked about the Midwest at the top of the hour, Milwaukee, Columbus, Cincinnati, Madison. I mean, these cities like what? Who? Des Moines, and so on and so forth, right? So amazing opportunities, opportunities.
Yeah. And guys, the last thing I'll say is find deals that have creativity. Some of the deals that we've gotten ourselves into have some sort of, I don't use the word subsidy, but some sort of an involvement from the local municipality, be that a real estate tax credit, be that a other incentives or whatever it is, some other way to sweeten the pot. A lot of those programs are out there, and a lot of people view those things to be niche programs. Like, oh, well, unless you're either on the inside or the outside, unless you know how to use something like that and how to get, tax credits or whatever it may be for your deal, it's not going to work. Those programs are there for folks like us, landlords, those that are providing housing, to take advantage of. Maybe it makes sense for you to take advantage of some of the programs like low-income housing tax credits. Doesn't mean you have to rent, for a third of what your market price would be. It just means you have to rent at or around the median of the property that's in. And there's some like restrictions on income that people can make, and some restrictions on property managers. So look into those programs, because those programs throw a lot of money to folks looking to provide affordable housing or historic preservation tax credits, or tax incentivized financing like we have here at one of our other projects, or doing a project in New Jersey, that has a tax abatement for the next 20 years. Real estate taxes are locked, right? Things like that, guys, used to be just for people in the know. Those programs have always been there, but if you want to find a way to mitigate pricing gaps, right, then that's a way you could do it, is by knowing something doing some homework that nobody else is willing to do, filling out an application that thick in exchange for a ridiculous amount of incentives and tax credits for your deal that might make it make sense.
Absolutely. It makes it that much more palatable, right? And then all of a sudden, I think, you just get that many more investors interested in your deals because they're so used to looking at deals being put out there. I saw this one the other day. I was kind of shocked because it's very, very seasoned, very well-known operator, to go unnamed, but they put out a deal out there, with, I think, a 4.8% cash on cash return. I mean, it just scratched my head. I'm like, how are they doing this, right? And that's average, which you and I know both.
I looked at that deal too, man. I looked at that deal too, and we don't have to name the operator, but at the end of the day, you're like a 4.8% cash on cash. It means like the average life cycle cash flow for the deal is 4.8. And then magic fairy dust. What's that?
That means year one cash on cash has to be well below 1%.
Goose. Right? Yeah. It's probably, they're not going to pay that out. They're going to just, they're going to make you hold your breath for the first couple of years, right? Well, who wants to do that, right? But what they'll likely do, and by the way, that syndicator does pay a pref for most of their opportunities. So that means that you're performing below the pref the entire life cycle of the investment, and you're hoping you get it back on sale. Because if you look at the underwriting, magic fairy dust on this, it gets sprinkled on this deal, and all of a sudden it sells for like a 14% IRR when they sell in year 5 or year 7 or whatever it was.
That's it.
It's not up to me, Yeah, we're releasing a deal right now, small deal. We're going to be putting a deal on the market. What are they, like 9% cash on cash on average? And it's 13, 14, 50% IRR. Not comparing ourselves to that operator, but that's a good deal. That's a deal that, there's a small ramp up period. Yeah, it's low to mid single digits in the beginning, but then it gets up into the double digits towards the end of the hold cycle. That's the kind of deal you guys want to find. And with enough patience and enough market focus, those deals are there.
That's it. Absolutely.
Right.
Absolutely.
So, Hervé, appreciate you gazing into your somewhat foggy crystal ball.
I do my best, man. Looking forward, it's tough. Sometimes I feel, like I'm just running in the fog kind of a thing right now. Hope that, the lights that are coming towards me is not from an 18-wheel Mack truck.
Well, I think that we're a disciplined company. We say no a lot more than we say yes, and my guidance is to anybody watching is to do the same. To summarize it here for you guys, market focus, pick one market. Use Hervé's Market Hunter tool to pick that market or validate the market you're looking at. I'll validate the market you're in now and make sure it scores well on the Market Hunter tool. DeRosaGroup.com/market tool. 2 T's, market tool. Go get a copy right now. That's number one, market focus. Number 2, creativity. We didn't really talk that much about seller financing today, but that is a creative factor that a lot of people use. So get creative on how you're going to structure the deal, including using third-party involvement, such as the local government or whatever it may be, to provide some other incentives to make your deal creative, to make your deal work. So creativity, those 2 things, guys, and just keep your ear to the ground. Talk to brokers regularly. Good deals do come up. They just might not come up for you if you're not plugged in. Like Gordon Gekko, right, from Wall Street, you're either on the inside or you're on the outside.
That's it. That's it. So
that's
true.
it. All right, guys. Thank you, Hervé, for joining me here on Cashflow Digest. Have to have you back on again soon to talk more market stuff. And you and I are working on some really neat stuff in the DeRosa Income Fund. We'll have to have you back on and talk about some specific investments and some of the borrowers for DeRosa Income Fund that are doing some amazing stuff. We're going to be having you back on, which talk to those guys too. So, Hervé, appreciate you always, man.
Thank you, man. Appreciate you being on. You do have a couple of shout outs in the comments section, Matt, if you want to make sure you.
No, I know. It's my man Waldis Santana right here. This guy. Yeah. You met Waldis, man. He's one of my original, college students, mentees, was a tenant and is now a successful landlord because he graduated up from tenancy up to landlorddom through working with the DeRosa Group. We financed the purchase of the building that he was a tenant in and bought the building from us through financing that I put together for him. Evan Loader, appreciate you, man, as always, in that. And if you guys want to do some deals, hit up my man Thomas Smirl. He's got deals. He's got things to do. Work with him. Find him on the DeRosa Facebook page. He did his post there. I want you guys all to grab his information. Thomas Smirl has on and off the market deals. Do it up. Santana, appreciate you, man. Those are our shout outs today, guys. Hervé, thanks again for being here today, buddy. I'll see you next time I have you on the Cashflow Digest.
Thank you, my man. It's a weekend.
Yeah, you too. All right, guys. That is yet another Cashflow Digest episode in the books. Feel free to like this episode on Spotify if you're watching it there. If you're watching a YouTube segment of it, make sure you like it and subscribe to our YouTube channel, and make sure you leave a comment anywhere you're watching it. Leave a comment. We love engaging with our communities and having conversations with people. So make sure you like it, comment it, share it, get the word out. We're doing great stuff here at DeRosa, talking all kinds of real estate shop with people. Have a great weekend, guys that are watching live. Thank you so much for watching this program, and we'll see you on the next one.